Most people believe wealth comes from income. Work longer, earn more, save more. That formula sounds logical, but something about it quietly fails. Because income grows slowly, and expenses grow quickly. Many people work for decades and still feel financially stuck. Now consider a different path. Instead of increasing income, you build a system where assets work continuously, even when you are not working. One of the clearest examples of this system is rental real estate. But not for the reason most people think. People assume rental income is the goal. Monthly rent looks attractive. But rent is not the real story. Rent is only the surface layer. The deeper mechanism is something far more powerful. Because a rental property does something unusual. It grows wealth from multiple directions at the same time. 4 directions. Income. Market growth. Debt reduction. Tax efficiency. Most investments only move in one direction. Real estate moves in 4. And when these forces combine, something interesting begins to happen. Let us start with a simple situation. Imagine a small property priced at $400,000. An investor purchases it with a 20% down payment. That means $80,000 comes from the investor. The remaining $320,000 comes from the bank. Right away, something important has happened. The investor controls a $400,000 asset. But only $80,000 came from personal capital. That is leverage. And leverage changes the scale of investing. Now the property is rented. A tenant pays $2,000 every month. At first glance, it looks like simple income. But inside that payment, something deeper is happening. Part of the rent pays operating expenses, insurance, taxes, maintenance. Another part goes toward the mortgage. Inside the mortgage payment, there are 2 pieces. Interest and principal. The principal portion slowly reduces the loan balance. Every month the debt becomes smaller. But the investor is not paying it. The tenant is. The tenant is gradually buying the property for the investor. Quietly. Month after month. Now something else happens during the same period. Property values often rise over time. Not perfectly, not every year, but across long periods, housing demand tends to grow. Population increases, cities expand, construction costs rise. Now imagine property prices increase 3% annually. A $400,000 property becomes roughly $530,000 after 10 years. Notice something interesting here. The investor receives the full benefit of that growth, even though most of the purchase price came from the bank. This is the moment many people experience their first wealth shock, because the math feels surprising. The investor only put $80,000 into the deal, but the property gained $130,000 in value. Leverage magnified the return. But the story does not end there. During those same 10 years, the loan balance was shrinking. Suppose the mortgage balance falls from $320,000 to about $270,000. Now look at the situation. Property value $530,000. Loan balance $270,000. Equity equals $260,000. The original investment was $80,000. The equity is now more than triple that amount. And the property may still be producing monthly cash flow. Even a modest surplus matters. Imagine the property produces $200 per month after expenses. That equals $2,400 per year. Over 10 years, that becomes $24,000. Income that came from the asset, not from labor. Now pause for a moment. One property created three different financial outcomes: equity growth, debt reduction, income. And there is still one more layer many investors overlook: taxes. Real estate has unique tax treatment. Property owners can deduct depreciation. Depreciation represents the theoretical aging of the building. Even if the property value is rising, on paper the building appears to lose value. This accounting rule can reduce taxable income, which means investors sometimes keep more of their cash flow. That preserved capital becomes useful later. Often it becomes the down payment for another property. Now something fascinating begins to happen. The system starts repeating. The second property begins operating. Then a third. Each property runs the same financial engine: income, appreciation, loan reduction, tax advantages. This repetition creates a compounding network of assets. And this is where wealth often accelerates. But here's the surprising truth. The biggest shift usually happens after the first property, because the first property changes perspective. Before owning real estate, many people think in terms of paychecks. After owning a rental property, they begin thinking in terms of systems. Systems that generate value continuously. Now imagine 20 years passing. The mortgage balance has declined dramatically. Eventually, it disappears completely. The tenant is still paying rent, but the bank is no longer involved. Now the income becomes significantly larger, and the property itself may be worth much more than the purchase price. At this stage, investors sometimes experience another realization. The property they almost did not buy, the one that seemed risky years ago, became one of the most valuable decisions they ever made. Not because of short-term profit, because of long-term structure. Real estate rewards patience. The system needs time to operate. Debt must shrink. Equity must expand. Markets must grow gradually. But when these processes run together for decades, the results become powerful. Many investors describe this effect as an equity snowball. Small in the beginning, almost invisible, but gradually gaining size. Momentum and stability. And the most fascinating part of the story is this: the wealth did not appear suddenly. It accumulated quietly, year after year, while life continued normally. That quiet accumulation is what surprises people most, because financial transformation rarely looks dramatic in real time. It looks ordinary. A property, a tenant, a monthly payment. But beneath that simple routine, a financial engine keeps running. And every year the numbers move in the same direction. More equity, less debt, more stability, more options. This is why experienced investors focus so heavily on structure. They know the right system can operate for decades. And once that system starts, time becomes the most powerful partner. If this deeper view of real estate changed the way you think about wealth, consider subscribing, because understanding financial systems is often the first step toward building one yourself.